We've been watching the dollar very closely because after a 8-month decline, it is starting to rally over the last 4 to 6 weeks. I'll be watching to see if the dollar can break out, because if it does, it could have a negative impact on 3 different asset classes. Number 1, multinational stocks. Number 2, commodities. And number 3, emerging markets. The problem that a higher dollar poses for multinational companies like IBM and Apple Computer is that they get most of their, or at least a lot of their, earnings from overseas. The reason a higher dollar is a problem for commodities is because most commodities are denominated in the dollar. As the dollar moves higher, it becomes more expensive for them to buy their goods. A higher dollar is particularly negative for the emerging markets because their debt is denominated in US dollars. And if you look over the long term, the correlation between the US dollar and the EEM, Emerging Markets ETF, is in complete opposite. Every time the dollar goes up, the EEM goes down, and vice versa. Having said all this, a higher dollar is not negative for everybody. Domestic companies in the small cap area, like the Russell 2000, tend to do very well because most of their business is done here in the US. Therefore, although we could see a big pickup in volatility in several different markets, it doesn't mean that the broad stock market has to go down. The small cap stocks could make up for what happens in the large cap stocks, and we could stay relatively flat. For Trading Nation, I'm Matt Maley from Miller Tabak.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.